Hi everyone. Today we're going to be talking about something very interesting. Pretty light. It's not going to be very technical, but I found this pretty interesting. This is actually a particular article, not an article. It's like a column in the Times Property a newspaper. My father actually had showed me this column, and he thought that it would be interesting for me, and it was interesting for me. And I just read through the first particular question that was asked in this particular column or this particular section in this newspaper, and I thought I would share, what I found and what are the learnings that I got from it, and hopefully it will be interesting to you as well. This is actually a section in the Times Property newspaper, 31st December newspaper of Times Property, and it's basically a section where certain questions related to, I guess, property taxation matters are asked, and uh, Ashok Shah sir, who's a tax partner in NA Shah Associates LLP, he's answering these questions, and it's published in the newspaper as well. So I thought I would just go through some of them. I'm just going to go through the first one because I found the first one interesting. So let me just read the first one, and let's see what it brings us to. So it's a question. The question says, I'll just read it out. Let me just see if everything's working out. Yeah, cool, everything's done. So it says that a project where I had booked a flat in 2010 has been stalled at first floor level since 2014. There was no agreement registered, only allotment letter given. We approached the consumer court and got an order asking the builder to register the agreement, hand over the property within 4 years, and pay interest at the rate of 8.5% for the delayed period. However, despite this, the construction did not commence and agreement is still not registered. Recently, the builder is offering complete money back with 10% interest. We have two observations in this regard. The interest will be taxed as income at the relevant tax slab, or it is considered as capital gain, and the value of the property can be offset at the present ready reckoner rate. That's the present rates. Thus, if another property is bought, no tax will be charged. Which one of the two is correct? So Dinshaoji is asking this question, and I just try to make a sense out of this question where you can just see it over here. So this is basically what the question is asking. There's a lot of stuff that is not really relevant from a taxation point of view, but we're just going to cover it anyway. But we're going to focus on what is relevant from the taxation point of view. So the person, Dinshaoji, booked a flat. That means he purchased and he paid some advance money for a flat in 2010. Now, certain construction was going on. Construction had commenced, but in 2014 it was stopped. First, for whatever reason, it was stopped at the first floor level. And the thing is that when the booking was made, no agreement was signed. There was no formal agreement for transfer of a property. Only an allotment letter was given. Now I understand that in the the real estate sector, and when booking these properties and all, when you make an advance payment, there is no agreement that is signed. There is an allotment letter that the builder gives you. That's what I understand from reading one article which I'll come to now. So an allotment letter is given. So now, basis this allotment letter, the construction and all was starting. Now, since after 4 years nothing was done, these people went to the consumer court, and the consumer court passed an order telling the builder to first register an agreement, hand over the property within 4 years. He has to hand over the property within 4 years, and interest for the delay has to be paid at 8.5% per annum. Now, this is a part of the issue that's not really relevant. We'll find out that it's not really relevant by reading the or understanding the next portion of the question. So the next portion of the question says that construction still has not commenced till the present day. Construction still has not commenced. So this was passed in 2014, but till present day, still the builder has not commenced any construction, and the agreement is still not registered. It is still on the basis of an allotment letter. Now the builder has told Dinshaoji, the builder has told him that builder has offered to completely give back the money. That is to completely offer to give back the complete money with an interest of 10% uh, for the delay. So that means the allotment letter has been cancelled. This whole transfer of property that whole situation has been surrendered or has been cancelled, and money along with interest has been given. So now this particular person is asking, what is the taxation impact? Because what's happening, first you paid some money in 2010, and today you're getting some more money, right? So what's the taxation impact? And that more money is because of the interest. Now, can that interest be taxable at income from other sources, or can you take it as capital gains? Because you can treat the allotment letter as a purchase, getting the allotment letter as a purchase, and now finally surrender as you can treat it as a sale. So there'll be a capital gain on that. So can you treat this as a capital gain? So now the question is, how can you treat it? So now the answer is given in the article as well. So we'll first look at the answer in the article, and then I've also written down what my understanding is of that answer, and a little bit more explanation I've given, and we can close the matter like that. So the answer that's given by Ashok Shah sir is, since the builder is paying 10% interest for the delayed period at the time of cancellation, the same will be chargeable as income tax from other sources and taxed as per the slab rate. Okay, perfect. However, if the builder were to pay the amount as and by way of consideration for cancellation of the allotment letter, it is possible for you, based on certain judicial precedents, we'll come to that judicial precedents, to claim that long-term capital gain has arisen, and you can claim deduction under section 54F by investing the consideration amount in another residential property or specified bond, subject to satisfaction of other conditions. Yes. So he's giving both the cases, LTCG. I mean, you can take it as an LTCG, and you can get the section 54F deduction also, or you can directly take it as income from other sources, where it will directly be taxable. Better option will obviously be taking it as LTCG. So now let us see what the yeah let us see how I have just explained and how I have just understood this particular issue. So first, I talk about whether can it be an income from other source. Yes, of course, taxable at the slab rates, no problem over there. You can also treat it as capital gains. Now when you treat it as capital gains, now the thing is that why can it be treated as capital gains? Because cancellation of an allotment letter is considered as a transfer, and acquiring allotment letter is acquiring rights in the property, and acquiring rights in the property is a capital asset under section 214. Now if you look at actually section 2 clause 14, rights in an immovable property is not specifically given as a wording for capital asset, but there's a particular case, that is Mukesh Sohanraj Vardhan versus ITO. In judgment was passed in 2020, and it was passed by the ITAT in Mumbai. Now, in that particular case, that case was exactly the same thing only. Allotment letter ka issue was there. Now they have construed that even an allotment letter, if you acquire an allotment letter, you are acquiring rights in the property, and acquiring rights in the property is construed as a capital asset by the ITAT. So taking this judgment into account, you can apply the same thing here, and you can take it as capital gains as well. And cancellation of the allotment letter can be taken as a transfer. So basis this, you can treat it as capital gains. Now, what benefits can you get uh, for treating this as capital gains? You can get, the article said section 54F, but I feel that section 54 cut deduction and section 54 EC article actually says bonds cut deduction, but did not specify section 54 EC. But what he was meaning was section 54 EC, section 54F, section 54 EC, and section 54. When, in what situations can you use the section 54 deduction? Is if the property that you are transferring, that is this property that you have cancelled, is a residential house property and it is a long-term capital asset. That means you've held it for more than 2 years. Then and it is what you have acquired is one residential house property in India, and this has to be acquired at least within the transfer of the first initial property, or after 2 years from the transfer, or if you have to construct after 3 years from the transfer. If you're taking the section 54F deduction, then this is for for a property that is any long-term capital asset except residential house property, which is basically in this case would be a commercial house property. So what in the article would have been assumed is that it's a commercial property that was initially transferred, not a house property. So if it's a commercial property that is transferred, then you can take it as a take the section 54F deduction, and what you've acquired is the same as section 54, the residential house property in India, one residential house property in India, and the time limits are the same as section 54. And you can take also section 54 EC, that is your classic 54 EC bonds, that is your bonds, your RECL, that PFRCL bonds, all that stuff. So you can take those, or NHAI bonds, you can take those bonds, and whatever property, this is applicable for any property, whether it's commercial or whether it's residential house property. What amount you get, you can invest it in the bonds, and that will be taken as a deduction up to the maximum limit of rupees 50 lakhs. The other two sections don't have a maximum limit, but of course the deduction will be your capital gains amount or the cost of the new asset, whichever is lower. In the case of section 54F, the deduction will be your long-term capital gains amount into the cost of your new asset divided by your net consideration. That is, it is in the proportion of how much of the net consideration you have actually used to buy the new asset. That proportion, the capital gains, you will get as a deduction. So that is the deduction portion, the benefit portion. Now, just now, one thing came into my mind is what would I consider as the cost of acquisition? Now, obviously, the full value of consideration will be how much I received from the builder. Now, my cost of acquisition, I would now assume that my cost of acquisition can be nil or can be the initial amount of advance that I paid. I think I would take it as the initial amount of the advance because obviously you're purchasing for that and you're selling now. So I think I would take that, or yeah, correct. I would take that as the original amount because anyway it will set off, right? Only thing is that if you're taking it as the original amount, and if it is a long-term capital asset, then you can get an indexation benefit also. So that's how you can consider it. Otherwise, only the interest amount will be taxable as a long-term capital gain, which I feel is not correct because you can generally only the interest amount won't be a long-term capital gain. You take the whole amount, the initial amount of advance plus the interest as the full value of consideration. Take the cost of acquisition as how much advance you paid, because if it is a long-term capital asset, then you can index it, get the indexation benefit also, and then you take this section 54, 54F or 54 EC deduction. Now, that is how you treat this. Now, I got to know this particular case, and I got more clarity from housing.com. Had an article here, our profits on the cancellation of property deal taxable. So I checked it here, and this gave me a little bit more clarity. As you can see here, that it writes about the definition. It writes about the Mumbai ITAT's order, and the clarification it gives on the definition of a capital asset, that is including the acquiring rights by acquiring an allotment letter. So basically, the ambiguity here was, can an allotment letter be considered as a right to the property? What the ITO had an issue here was, they said that the allotment letter cannot be treated as a right to the property. You need to have an agreement for the sale and purchase. But the ITAT said, even the CIT appeals also was of the same opinion. But the ITAT said, no, even the allotment letter can be considered as an right to acquire a property. And it comes under the definition of a capital asset. So even if the allotment letter is surrendered, you can treat the surrender as a capital gain, and you can get the benefit instead of taking it as income from other sources and end up paying more tax. So that was basically this. I just kept the definition. I wanted to just show you the definition of capital asset here, but I don't feel it's very relevant now because anyway those wordings are not there in section 2 clause 14. It was uh, it was construed to be there by the ITAT. So it was in this case law. uh, Mukesh Sohanraj Vardhan was a ITO. So you can refer this case law to have more clarity for this particular uh, issue, because you can see that the article, Ashok Shah sir says that certain judicial, he's used the words based on certain judicial precedents. So the judicial precedent that he is referring to is Mukesh Sohanraj Vardhan versus ITO, where the order was passed in 2020 itself. Yeah, so I just found this interesting. I hope to have more of such videos, and yeah, hope you found this pretty interesting as well. Thanks. That's all from my side.